Hello everyone, welcome to Deloitte's podcast. Today we are going to discuss the developments focusing on OECD's two-pillar solutions to address the tax challenges arising from digitalization of the economy. With the release of the OECD report on Amount B in February 2024, we will delve into understanding the concept and implications of this new framework with our Deloitte subject matter experts. We are pleased to have with us Anish Chakravarty, Asia Transfer Pricing Leader, and Tarun Arora, India Transfer Pricing Leader. So without much ado, let me ask my first question to you, Anish. As you're aware, as part of the ongoing work of the OECD G20 Inclusive Framework on BEPS to implement the two-pillar solution to address the tax challenges arising from the digitalization of the economy, the OECD has released a report on Amount B on Feb 19, 2024. Anish, it would be great if you can explain to us the concept of Amount B and what is its scope and coverage.
The concept of Amount B is a remuneration for enterprises undertaking baseline marketing and distribution activities using what has been defined as a simplified and streamlined approach. Now, it will apply to all multinational businesses that undertake routine distribution activities, unlike Amount A, which is limited to the world's largest multinationals, and as we know, there are thresholds being prescribed for that as well. Now, what is the scope for Amount B? Well, qualifying transactions as defined must exhibit economically relevant characteristics, with the distributor, sales agent or commissioner being the tested party and also meeting specific operating expense criteria. Now, there are two kinds of transactions which have been defined here. First, buy-sell marketing and distribution transactions, and secondly, sales agency and commissioner transactions. Now, what is not in scope of Amount B? Well, digital, non-tangible goods and services are not covered in scope at this point of time. We must understand that the intent of Amount B is not so much to depart from the arm's length principle, but rather to allow a structured approach to distribution returns. Something that we've seen earlier before, for example, in Action 10, where the markup for low value-adding services range between 0 and 5%. And the intent is really to provide some level of alignment to taxpayers regarding their tested parties with these transactions and avoid the rigors of a diverse comparability analysis.
Thanks, Anish. I agree with your observation of Amount B, allowing a formulaic approach to distribution returns. However, it is surprising to note that companies in the space of digital goods and services are not covered in the scope, which was actually the starting point of having these pillars. So anyway, Tarun, one of the key elements of Pillar 1 is Amount A, which is basically a new taxing right. So how does Amount B differ from Amount A?
Pillar 1 is one of the two pillars being instituted for taxing the digital economy. It deals with two parts, Amount A and Amount B. Amount A is seeking to bring a new taxing right wherein multinational enterprises of super size and profits, a part of their profits will be taxed in market jurisdictions. On the other hand, Amount B of Pillar 1 is a streamlined and simplified approach to tax and determine returns for baseline marketing and distribution activities. Under Amount A, a part of the residual profit of the large enterprises is taxed in the market jurisdiction, while in Amount B, a simplified way to determine the return attributable to marketing activities is there.
Tarun, your breakdown of Amount A and Amount B clarifies the distinctions within the Pillar 1 framework. It's evident that both are crucial in addressing the complexities of taxing the digital economy while ensuring fair distribution of profits amongst jurisdictions. So as per the scope explained by you, it seems that Amount B has a wide coverage. Also, this so-called simplified and streamlined approach will also be incorporated into the OECD TP guidelines as annexed to Chapter 4 to be given effect for fiscal years commencing on or after Jan 1, 2025. Given this context, Anish, considering it's even less than a year now left, what according to you is the impact of Amount B expected to be at 1, a country level and 2, also at a corporate level?
At the outset, the OECD Economic Impact Assessment observes that Pillar 1 is broader than Amount A. Amount B of Pillar 1, for example, aims to provide increased tax certainty by creating standardized transfer pricing benchmarks for common transaction times, and as we've discussed, to streamline the administration of the arm's length principle and decrease costly transpricing disputes. The economic impact assessment does not include any quantitative modeling of the impacts of Amount B due to data limitations, and due to the fact that Amount B aims to simplify the administration of existing transpricing rules and therefore, unlike Amount A, does not seek to allocate new taxing rights. Now at the country level, it is important to note that implementation for Amount B is optional for countries. Countries with significant distribution and marketing activities but currently receiving minimal profit allocation, and that may be owing mostly to inadequate local comparable data, these countries may see an increase in tax revenues. Also, the guidance states that Amount B shall focus on low-capacity jurisdictions, though that has not been defined yet. Also, there are guardrails based on operating expense in respect of which India, as we know, has placed its reservations. India believes that value of a distributor's functional contribution is reflected in sales and not in operating expense. That's now at the country level. Now, if we focus on the corporate level, for large multinational corporations, implementing Amount B could lead to adjustments in their transpricing policies and profit allocation methodologies. Countries that adopt Amount B could make it mandatory for marketing and distribution enterprises in their jurisdictions, or they can retain it as a safe harbor. Challenges of double taxation could arise if there is a transaction between an associated enterprise in a country that, let's say, has subscribed to Amount B and another associated enterprise in a different country that has not subscribed to Amount B, say a baseline distributor.
Thanks, Anish. Your analysis of the potential impact of Amount B at both the country and the corporate levels lays its significance in reshaping TP dynamics. The optional nature of Amount B's implementation adds another layer of complexity for multinational corporations. Moving on to the view of India on Amount B, I understand that India has expressed a number of reservations in respect of Amount B. Tarun, it would be good to understand from you what are the implications of India's reservations considering the cross-border nature of TP.
India's reservations on Amount B are on two counts. One is on definitional aspects and the other is on the core design of the concept of Amount B. On the core design part, India has raised a reservation on the fundamental aspect as operating expenses. Is that a right guardrail to determine the return attributable to baseline activities? And in India's view, operating expenses is not the right guardrail, but it should be other parameters such as sales generated, etc. Similarly, the definition of low capacity jurisdictions, on that issue, India has raised a point that what exactly is the definition of a low capacity jurisdiction to which Amount B can be applied for achieving simplicity. So that definition is not there. Another issue which has been raised is that the use of a single database for determining the returns attributable, whether that is the right approach or not. So, like I mentioned, there are various definitional issues related concerns which have been raised, as well as fundamental issues like whether operating expenses is the right guardrail for determining the return of distribution activities.
Thanks, Tarun. I completely agree with your observation. India's reservation regarding Amount B highlights the importance of addressing key design elements. Collaboration and refinement will be essential for its widespread adoption. Anish, given that you wear the AP lens and given the deadline of Jan 2025, what are the steps corporations at headquarters and at the country level should take in preparation for Amount B now that it is live?
The report outlines two implementation options for jurisdictions opting into the streamlined and simplified approach from January 2025. First of all, the jurisdictions have to decide whether to opt in or not. Now, there can be an instance where one country opts in for it and the other country opts out, resulting in double taxation. Now, this has been acknowledged by the OECD as well. In my view, companies have to undertake the following steps if they're opting for Amount B. First, engage with countries falling under the scope for Amount B. Secondly, determine if the jurisdictions adopting Amount B make it mandatory or optional. And optional, as we discussed, can be akin to a safe harbor. Third, but most importantly, review their existing transpricing policies and amend as required, considering the prescribed guidance. Last but not the least, monitor compliance to check for the double taxation scenario that we've spoken about. Now, the implementation of Amount B is one that is signaling largely towards the adoption of what we call operational transfer pricing. And that is in order for companies to set out their transfer prices for marketing and distribution transactions to yield a certain benchmark returns even at an SKU level or a segment or an entity level by adopting technology. And this technology can interface with their ERP to give them real-time information as may be required.
Thanks, Anish, for listing down the steps corporations should take in preparation for Amount B. It really emphasizes the need for proactive engagement and compliance monitoring by corporates. Therefore, I think MNCs must start planning for how TP policies will be impacted and also ensure they invest in an automated tool to implement the new TP operational aspects in their system. Tarun, given that OECD G20 inclusive framework on BEPS are working on the two-pillar approach to address the tax challenges arising from digitalization of the economy, how does the introduction of Amount B in Pillar 1 interplay with the ongoing implementation of Pillar 2?
Amount B and Pillar 2 are two separate but interrelated concepts. Both aim at achieving the objective of avoiding base erosion and profit shifting by multinational enterprises. However, their intent is slightly different in a way. So, Pillar 2 seeks to ensure that multinational enterprises pay minimum 15% tax in the jurisdictions that they operate in, while on the other hand, Amount B more focuses on allocating profits to the marketing and distribution activities. And Pillar 2 aims to establish a global minimum tax rate, like I said. Also, Pillar 2 requires that transactions between group companies or associate enterprises should be at arm's length, and that is where Amount B will have an interplay to determine what's the right return that should be taxed for distribution or marketing activities. And since Amount B is made optional for countries, it is possible that there might be a mismatch in jurisdictions applying the returns, and such mismatch would need to be dealt with under the mutual agreement procedures. So that is another interlinkage, but principally both are two different concepts. One is to ensure that a minimum tax is paid by enterprises, and the other is to determine the return for marketing activities.
Thanks, Tarun. This explanation is really helpful in understanding the intersection of Amount B with Pillar 2 and with the global tax initiatives in tackling BEPS. Addressing jurisdictional mismatches and double taxation will be critical in ensuring the effectiveness of both Pillar 2 and Amount B. And with that, we've reached the end of our podcast. Hope you found this useful and insightful. Do stay tuned for more insights and updates by Deloitte India on international taxation.